Warriors. Let's have a good week. Everyone doing okay? Hope you had a good weekend. So I want to start with what Blake and I were talking about. Blake pointed out the DSI on the dollar was 90. So we pulled back a little bit here. I'm watching this overthrow line for confirmation that we're going to get a correction here in the US dollar. Okay, so it's tried it here, didn't quite get to it here. Are we going to attempt a new high before that happens? That's possible, but part of the thesis for recovery in the market was the dollar stopped going up. So you could see the similarity in the pattern in the S&P. I actually think I'm going to have a chance to, someone may think that I'm smoking something, but I think I'll have a chance to sell the S&Ps back above 2,800 before the next decline to take out the lows here. I think we've reached a point of seller's exhaustion. I do think the Fed lows will give way, but I think there's going to be a nice opportunity after we correct this decline, that this may have completed. I don't know. I'm not a wave guy, but why can't this be ABC? And then we get some type of ABC up here and then finish it off. So that's what I'm looking for. I think the dollar has to cooperate. So the S&Ps are a little ahead of the pattern that I just showed in the dollar. Euro has the same pattern. Okay. So looking, I think it's possible that if the S&Ps are going to do this, that again, people might think I'm smoking something, but we've gotten rid of most of the dollar bears with this big rally in the dollar and euro bulls, but why can't we trade 119 while the market's recovering? The thing I'm going to be the most interested in is gold did it without the dollar. It's acting a little heavier now and actually did get above 1240, but can't close above 1240. One number I was looking for was 1245, 1246 from one of the guys I interviewed. It was pretty good. So, I also do these interviews. I'll admit it, I'm selfish. It's intelligence gathering from me. I try and bring in guys that give you some good ideas, that are also actionable. So, we've crossed the 300 mark in interviews here at Face. So if you ever have a lot of time on your hands and you're still very interested in the trading business, there's a wealth of knowledge in the library of conversations of people I've talked to. Even though we're talking about current, what their current views are, there's also a lot of teaching that goes on with psychology and methods. So yeah, you could go on do a binge learning Face webinars, Bob, instead of a TV show. Okay, so gold's having a little bit of this is what it's talking about. The weekly came in at 1240, the 50 week, and it poked above it, and high was 43. I mean, that's close enough. I'd be careful being long gold, but I was thinking, why would maybe gold goes down when the dollar goes down? It went up when the dollar went up. Maybe, like I said, or we've been talking about, the Dixie is a new VIX because stronger dollar is a problem for, not just our markets, but even more so for emerging and other markets that have dollar-denominated debt that they can't service. So what if there's relief in the market because the dollar stops strengthening? Will gold come off? So, if I didn't try to put the whole jigsaw puzzle together, I don't think I'd be long gold here. Maybe there's one more run, but to me now, and this is kind of how it is latter stages, that maybe silver takes over leadership. Silver looks more compressed. You know, maybe you get your move to $15 in silver, and the gold could only make a marginal new high now. So maybe we'll see mid 1240s. I know a lot of people are going to buy it on a breakout over 1240. So we'll see. Then there's other people looking for higher objectives, 1260. But the most interesting aspect about all commodities coming up is how they perform. And if they can't perform with a weaker dollar, if we get that weaker dollar, and the Dixie negates the throwover here, commodities you would think would get a lift with a weaker dollar, just like equities are getting a lift. So those are my calls. The next one's yours, 800-899-BEAR, 800-899-BEAR. Oh, that's an old phone number I had before Blake. Wasn't that a good number? It was during all the bull markets. I got a lot of calls from Vermont Teddy Bear Company who advertised a lot, you know, for all kinds of teddy bears. So people would call me asking for teddy bears. And let me just wrap it with this. Blake may not be ready. Is that, you know how Steve has mentioned, I've said it a million times, you can't learn experience. It only happens with the passing of time. But you can learn from the experienced. Okay, you can learn from the experienced. So there's quite a few experienced people here. I think if they include me, there's 150 years of experience with the team here.
150 years just from your side, you mean, Coach?
Yeah, yes. You know, Steve, did I tell you about that great party I went to with R.N. Elliott and Jesse Livermore in 1928?
I think actually you were the organizer.
Yeah, I was. You know, I was their mentor. I was their mentor.
Yeah. Yeah.
Anyway, Steve, I have to go get some Windex to clean off the glass over my tape. I'm a tape reader. Are you taking over? You coming on now, buddy?
No. I just wanted to, you know, to join you in a humorous Monday morning comment.
Well, I feel that old today. Paulie.
Your spirit is one. You have the spirit of a 20-year-old.
Oh, thank you. Those guys were right. That I went back to work too soon, and I have another upper respiratory. But you know, I don't think it's pneumonia. So anyway, I'm really looking at this dollar, Steve, as being kind of the linchpin to everything. What do you think of that commentary that, you know, indexes are exhausted to the downside? They may have completed, you know, maybe an A wave or something, and, you know, really get a nice rally, maybe into the election or something like that, all the way back towards 2,800 S&P?
I think it's not going to be easy.
It's not going to be easy for that to happen.
No,
yeah.
Coach, I think it's not going to be easy. I think we already have a technical damage in our hands.
Yeah.
And I think that even if this is not the beginning of a bear market, which statistically speaking, the chances are always that you don't have like a top in the market. So whenever you have a very well-established trend, you know, statistically speaking, calling out, you know, the top is obviously a low probability event, right? But
okay, so you don't think there's a shot, if you look at my screen, for the NAS to rally back to here and then go to
of course there is a possibility of a rebound.
I do think we're going here.
I just think it's not going to be easy. For example, you mentioned the S&P as an example. So, for example, I think it's not going to be easy going above 2,800 in the S&P. because I think that the market dynamics have already shifted somewhat.
Yeah.
And it's not going to be easy. Will they try to do it? Yes, but my prognosis is the following: and unless the Fed capitulates and throws a bone to the market, I don't think that the recovery is going to be. It's going to be easy seeing like a big recovery, but I don't want to eat into Blake's time. So let's hear his opinion about that, and I'll be here for the rest of the hours. As always. What do you think? What do you think, Blake? Do you think it's going to be easy without the Fed hinting to perhaps a pause to see a rebound above like 2800, 2820, which was the previous
treat,
Blake.
Good morning. I don't think it's really the I don't think it's the Fed so much that's going to be impacting the markets. I think it's going to be more the elections, as Dale alluded to, and I'm not sure it's going to be as easy as the market believes that the Democrats are going to have this big blue wave, and I think the markets are going to cheer it. So I think that the market, rallying to 2,800 in the S&P, I don't think that's a far cry of what can happen. I think that I do agree with you, Steve. I think the technical damage has been done, and I think that we should be selling rallies versus buying dips. But I
not sell rallies into the hole.
No.
Right.
And that's the thing. And I don't necessarily think that's the wise trade.
I don't want to interrupt, Blake, but I want to mention something because it's statistical significant. It's very weird because the Republicans are claiming, of course, they're trying to blame, Trump is trying to blame the Fed, and the Republicans are claiming that the rout in the markets is due to perhaps jitters that the Democrats might get the House of Representatives, which is a high chance, and there is a low chance that they might even get the Senate. But the thing is, and many people haven't noticed, is that a month and a half ago, before we had the whole Kavanaugh thing, the chances actually that
They dropped.
that the Democrats would get the House of Representatives were extremely higher, and they even had a decent chance in getting the Senate. And back then, the market seemed to be completely ignoring that. So I'm not so sure that the excuse that the Republicans are giving about the jitters of the market is correct, because if that was the case, the markets should have been selling earlier and doing a little bit better now, because the chances have actually dropped. Because as it seems, the Kavanaugh case, what is the word, brought Republicans, made them, brought them closer to the probability of going to the polls and actually voting, for the Republican Party. So I'm not sure about that.
Steve, do you think Judge Kavanaugh has a beer once in a while, right at the Supreme Court bench? Pops one open?
That's not my thing to
Blake,
solve.
what do you think?
He likes beer.
Yeah.
Likes beer.
All right,
so as far as the equity markets go, though, I think the risk actually is for a near-term, relief rally. Where are we going to go from here? I mean, will we make it all the way to 2,800? Yeah, it's possible. I don't think I'd want to be short equities right now, though. I don't think that's the right trade. I mean, it may be right at this moment, like at this very second in time, but I mean, I'm talking over the next week or two. I think we could rally going into the elections. I think that's entirely possible. So,
but they're going to give it a try. I have no doubt about it. Let's see.
I mean, the question is how far will we rally if we do. But anyway, that we'll see. I mean, as far as equities go, I think that we have really this is a real critical resistance zone for the S&P would be right through here. About the 2,700 to 27, 25. I think that's all pretty critical. And as you see, I don't know if I don't know, is Stelios here yet? I don't know if he's coming in. If he's
I am here. I am here.
He's
Okay, so Stelios, how what do we make of the German elections? I mean, looks like we're going to lose Angela Merkel, and you know, is change bad? Is change welcome? Is is this expected? What do you say?
Well, first thing to note is that she is stepping down as the leader, basically, of the Christian Democrat Party, but she will remain chancellor until the elections in 2021. So that will give enough time for whoever replaces her to build a profile and do all the work required to build up to the elections. Now, your question is this a good or a bad thing? I've been thinking about it for quite some time. Well, since it was announced this morning, and I can't make my mind up. And neither apparently can the market, because the euro sold off initially, then it rallied a bit. Now it's come back to unchanged. So
it will
I actually don't know.
Who replaces her. It will depend on who replaces her, and it's too early to know.
And the thing is, the comments that I read is that there are a lot of people who say, she's been in power for too long, and when somebody's in power for too long, you tend to lose, they lose the big picture, and you start to get involved in things that maybe should have warranted less of your time. So it's a good question. I don't know. Personally, I think that Merkel had done a very good job for her country and for Europe for many years, and like Steve said, it depends on who's going to replace her. But are we going to see a leader who will come in and step in her shoes? I mean, Merkel has made some mistakes for sure, but overall, I think she's done a pretty good job. So what are the chances of Germany finding somebody to replace her? No, her party finding someone to replace her who will continue this drive that has brought Germany in such a good, condition and through the whole.
Stel, probably it's the chances are just as good as the UK finding someone good after Thatcher.
Oh my God, that's exactly what I was about to say.
Really, Steve?
Yeah.
Oh my God, the great Truskin is here.
Yeah, you see, big minds think alike. That's what I want to say. Is that the British were actually sent Thatcher away after, what was it, 8-9 years or whatever, thinking that they can do better. And looking back, I know that
disaster after disaster.
Yeah, exactly. And not only that, even going further back in time, just tell me, generation after generation, do we actually, in general, globally, get better or worse politicians? I mean, let's be honest. I think that the chances that Merkel is going to be replaced by a person that has more abilities, is more capable as a leader, is as strong as she was, as calm as she was, because Merkel had also the extreme benefit of being a person that never reacted emotionally or irrationally or too early or was jumping the gun, and that helped in many, many situations. She was also a person that seemed completely unaffected by the short-term mood swings, which is also an extremely important characteristic that any leader should have. So I really believe that the Germans are tired because she has been in power for 18 years. So they want to see something different. But I'm afraid that the chances that are going to see something different that's going to be better are rather low.
Yeah. Well, and the euro is kind of indifferent right now. I mean, we did come off after the news. We're selling off a little bit here. I don't know if that's more dollar related or euro related, if you will. But it seems like the market's kind of shrugged its shoulders for now. So I think your comments are probably succinct as far as it's who's going to step in as leader and be who the market's looking for. So, but technically,
Blake, theoretically speaking, the markets are discounting forward. Theoretically speaking, like financial analysts have calculated that the markets are usually like pricing in like 6 to 9 months ahead. And since Merkel is staying in power until 2021, perhaps this is the most important reason why we're not seeing any big response. I don't think that the market is going to start pricing it in already.
Yeah, I mean, that is, quite some time away, which is a really good point. So as far as the euro, I guess technically, what do you do with it? I mean, I'm still long a little euro from Friday, and we're just kind of sitting around. We came out of this descending wedge, but really we have to get above 114.30 in order for it to scare any shorts. This is the I think technically what the market should be looking at would be right about here, right about there. And I think and as long as we stay below that 114.30, the shorts remain. Now there's another issue that we're facing going into the end of the month. There's been people are blaming a lot of the dollar strength on repatriation of dollars going into month end. So, as you go into month end, you get, some dollar buying. That's been the case for the last several months. And I'm not sure if we're going to get that again, but I think people are playing into that as well. You got, the cables pretty unchanged. We're just kind of we're in this down channel, and really we have to break above 128.60 in order for the or 128.80, excuse me, in order for the cable to get any kind of technical lift. We have a big week this week as far as the pound goes, with the Bank of England and their rate decision on Thursday, and then trying to get a decent I guess a budget's trying to be drawn up, but it's hard to figure out what the budget's going to be, based on what's going to happen regarding Brexit. So that's kind of an interesting task that's at hand for the UK right now. So the cable's just kind of sideways. We're seeing a little bit of bounce in the Aussie and the Kiwi, because risk appetite is, generally speaking, it's stronger today, and you've got potential false breakouts in the dollar Canadian. The US dollar Mexican peso is a little weaker today, and I think a lot of that has to do with the elections that happen in Brazil over the weekend, and you have AMLO is going to be coming into. I don't know Stelios, do you know when the new incoming president for Mexico takes over? It's got to be this upcoming month, like here within the next few days, I think.
Good question, actually. I thought it was in my mind, for some reason I had the end of the year, but it might be sooner.
Yeah, in my mind it was in November, but I'm not sure if we have the exact date. But the US dollar Mexican peso, we took out the 1970 level, and did like a little bit of a false breakout this morning, but it's still being bid at this moment. And then we had the election in Brazil, which one of my friends is married to a Brazilian woman, and she was really happy with the newly elected president there, who's would be looked at as the Trump of Brazil, I guess, would be the way you could look at that. But anyway, so maybe
he's
some of
tough,
this.
Blake. He can take knives to the gut and still survive, right? I mean,
I don't know much about him. I really don't.
He got stabbed. That's why they had to delay the elections.
My gosh. Well,
yeah, it's tough campaigning down there, man.
I guess.
Blake, December 1st, actually. I just checked.
December 1st. Thank you very much. Okay, so we're a month away from that. So, overall, there's some volatility in the FX market right now. I think that a lot of this, the moves you're seeing here are going to be a result of what we see in equities, and like I said, I think I agree with you, Dale. I think that equities do have the chance of bouncing here. One of the things that was set up on Friday is this little false breakdown. You had everybody flushed out of the market. We hit new trend lows, and then we spike back up, and here we are back above 26.85, which I thought was really big support. It was a 618, it was horizontal support. We cracked through all of that, and then we bounced back. So being being short equities, I don't know, I think it's a risky proposition, especially if you get above 27.25. So we'll see. We'll see how equities respond here. But like I said, I don't think I'd want to be on the short side right now, especially after the nice drop that we've seen. We haven't completed this AB equals CD type of move, but I still think that the risk is, back to the 200-day, maybe a little bit above it, and then, set up for a good short going into year end. That's what I would think.
What would make you constructive, Euro, Blake? What kind of price action would you need?
We'd have to see. Well, first of all, we had a great looking hammer on Friday.
Yeah, right.
What I'd really prefer to see for the euro to turn bullish here is we'd have to get above 114.30. So
thank you.
Yeah, 114.30 would tell me that the near term downside's over. And it's not like the euro hasn't been chock full of false breakouts and volatility and sloppy trading. I mean, that's been kind of the key characteristic of the euro as of recently. You think you got one pattern ready to go, and then all of a sudden it just flips around really fast. So as far as right now goes, the euro dollar, I think, is just kind of let's see what happens if we break above 114.30. I think that's where things get a little squeezier. And I want to reiterate that I think the market is really trying to play into.
One second, Blake. Stelio, Merkel is speaking at the moment, so if you can have a look at what she says and share it with us whenever. Thank you.
Sure.
So right now, I think at this stage in the game, you just gotta watch the price action in the euro. If you break above 114.30, I think that's where things get a little rocky, because like I was just saying, that I think the market is playing into dollar strength and buying dollars today. They've been buying dollars, going into month end. So that whether or not that reverses, I think you're going to have to see some technical moves, to squeeze them out. But
is the DSI as extreme in the euro as it was in the dollar when it was 90 in the dollar last Thursday or Friday?
Let me go see if I can. It worked off some of the extreme readings, but
really it was nothing.
You know what? I have to go back and I have to go back and look. I'll report back to you on that.
Okay.
But,
thank you, buddy.
All right, guys. Well, hey, so I'm going to pass it over to Steve and Stelios. You guys have a great one. I know we have a time change this week, so it's it knocks everybody off everybody's schedule for at least a week. Until
everybody that's not in the US, So for everybody that's not in the US, it's 1 hour earlier. Exactly.
Yeah, and it's not, I know everybody tries to adjust their schedules for these webinars, but it's more of a, if you have a set schedule, everything reverts back in about a week. So, all right. So with that being said, I'm going to pass it over to Steve.
About the question for Euro DSI, last reading we had is 17.
Yeah, so
pretty low.
It's still pretty low, but we worked off. They were really extreme.
90 in the dollar.
Yeah, it was.
We had 11 2 days ago on Wednesday, and Thursday we had 11 in the euro. So it jumped from 11 to 17 actually.
Yeah.
Just because it held one day.
And dollar index at the exact same days was 90, and it dropped a little bit to 86. So it's still rather bullish.
Right, Steve. Okay, a couple of things. First of all, I want to say before you start, first
see
of
you,
all,
Blake.
See you, Blake. Yeah.
Bye, Blake.
See you guys.
A couple of things. First of all, thank you. I want to thank all the people in the on the webinar who are commenting. We can't remember everything, so Joseph, Martin, Olivier, Rick, thank you very much for your comments. I just saw now that people had written already when the Obrador was taken over, before I actually found it myself. Now, Merkel, she is speaking. She said a couple of things, nothing out of the ordinary. She said she's gonna will not be seeking re-election as chancellor. We knew that. She also said she's not going to be seeking political posts after her current term ends. So that's kind of, she's
Classy.
it seems like she's going to basically just step aside and not be involved with anything involved with government or public posts or anything like that.
Can you blame her?
I can't. She's had a good run and she has a very good reputation. So
she's gone through a lot too.
Plus, she's not like she's at her prime. I mean, I think she deserves getting some family time, relaxing, etc. Being at the head of like the flagship of the Europe for 18 years. Just imagine how much of a toll that had to her, right? I mean, it's not something every person can do, right?
Yeah.
She used to look like, who's that model you guys always want me to interview?
Which one? I can't remember.
Jameson or something? What is it?
Okay, moving on.
Merkel used to look like her.
Yeah. Okay.
By the way, Stelio, Trump just tweeted about Bolsonaro. He says had a very good conversation with the newly elected president of Brazil, who won his race by a substantial margin. We agreed that Brazil and the United States will work closely together on trade, military, and everything else. Excellent call. Wished him congrats. Just mentioning it.
The other thing that happened a couple of minutes ago, we had core PCE at 2% as expected. Remember, this is something that the Fed look at a lot. It's one of their preferred measures of inflation. Bang on target, 2% as expected. So no surprise there.
Yep. Okay. So anything else from?
I'm not seeing anything else. Actually, she did say a bit earlier that I found this quite interesting. She said the government is losing credibility, which is something you're not going to hear from many politicians nowadays, right? And I don't know the context in which she said it, but it was one of the quotes that I saw.
Quite a strong quote. Yeah, for sure.
Yeah.
Okay, interesting.
If anything else comes up, anything of note, I'm going to interrupt.
Okay, perfect. Please let me know. Okay, so we already have some questions. Let me have a fast look at them. Okay, the questions. Okay, so let me first reiterate here that definitely Friday's candle does point to a rebound. So it's not that I disagree that we might have a short-term rebound, and we might. First, let me say that if we're talking about the S&P, in my opinion, it remains, as I said this exact day when we were rebounding here, that 2745 is a key level for the bulls. So for me, once we confirm that we're actually rebounding higher today, after Friday's more or less reversal, we did close negative on Friday, but given how much lower we were and given the kind of candle that we left behind, which is a hammer, there is a possibility of rebound, but I would have to say that 2745 will remain a very important hurdle to overcome first before we can retest the next zone of resistance, which in my opinion is at 2785 to 2790. Now, it's not going to be easy going above that zone. And having to do with the DAX, because we do have a question about the DAX, the DAX has broken below its head and shoulders formation. You can see it here. It is rebounding from a confluence of supports that was the 50% fib of the last bull leg higher. You can see it here, and the 161.8% extension of this last little rebound that actually retested the neckline of the head and shoulders formation as a resistance before it failed. So I wrote in the end of week analysis that, in case we keep rebounding from here, this is the first area of resistance you should be looking for, the 11,450, 470, that zone. And above that, it's again the 11,800. As long as we remain below there, there is absolutely no reason why you should be looking higher. Because we have triggered the head and shoulders formation, and this is a very powerful technical formation. Can it get invalidated? Sure, it can. But until that happens, you have to respect the potential for more downside. So, this is, how reality is. Now, having to do with the FTSE almost, not almost, actually did touch the previous low that we had here before rebounding higher on Friday, and it's now back retesting the 7,100 area as resistance. It tested that, a few days ago for like 2-3 days. It failed every single time. I mentioned how important that was as resistance. So every single time we failed so far. So obviously you should be watching this area once again. Now, if we do break finally above 7,100, then yes, there will be the potential for some more upside towards 7,250 to 7,300. So I would be looking in that area for the next resistance, which means that if we do push through 7,100, there is a good potential for 100, 150 handles of more upside for the FTSE. But we first need to bridge through it because there is still a potential that we're going to get rejected once again. So, this is not the place to be buying. You might want to buy, as I said, a breakout, looking for 100, 150 more handles to the upside. And now if we have a look at the Nikkei, I warned about it. Once we fell back in the 22,000, 23,000 zone, I warned about it that these times that the chances are overwhelming that this time this range is going to be bridged to the downside. That's exactly what happened. And you need now to be looking at the 22,000 area as an area of resistance from this point on. So even if we do get, let's refib this, even if we do get, even if we assume, which is, jumping the gun because it's just an assumption, if we assume that on Friday we got a low and we assume that we see, rebounds on all indices, like, starting from here, from Friday's low, the first area of resistance is the 23.6% fee, but 21,665. 22,000 has proved how important of a zone it is. And then it's a 38.2, which you can see it coincides with some previous lows that we had at 22,200. In my opinion, there's a good possibility that we're going to get rejected at any point up to that area, to the 22,200 area and the 38.2. So any rebound, the closer we get to that area, probably the better the opportunity to be looking for more downside. Now let's also have a look at the Nasdaq. The Nasdaq did test the 61.8. From the beginning of the wedge that we had. So that was the low after the big move that we had unraveled the market at the end of January, beginning of February. The vast majority of the markets rolled over and we had that big sell-off. So that was the low. And we did touch this 61.8. In any case, I don't think it's going to be easy rebounding above 7,185. That was previous support resistance area. And the 200 DMA might also act as resistance. It did so on Thursday. When we rebounded initially on Thursday, we found resistance at the 200 DMA. That's at 7,073. These are the areas I would be looking for a probable failure in the Nasdaq. Now that we covered all the indices, we can go back to the FX, and I'm going to start by this tedious USD yen. That's why I got rid of half of my position and I closed the pattern in play, barely in profit. Because as you see, once again, for example, the bears got momentarily happy on Friday. It was looking like we're finally breaking down, and once again we got rejected from the 111.50 support. This pair is so obnoxious, so annoying to monitor. Everything else was breaking down, but the USD yen was finding it impossible to bridge through that zone. And we had a little false break below this ascending trend line. We barely closed below it. And so far today, we have completely retraced Friday's losses. So I don't know. If we do see, and we mentioned that several days ago with Dale, if we do see a rebound from here in the indices, there is a good chance that the USD yen is going to give a better opportunity to short it, perhaps at the confluence of the 61.8 of the last move lower and this horizontal resistance area, roughly at 113 to 113.50. So we might make it
probably
there.
a lot of people thought
Yeah.
they missed a short on Friday, and you did.
Yeah, but as it seems, they didn't. Yeah, as
Right.
it seems, so far they didn't.
Nice look.
Now, having to do with the euro and the cable, personally, I'm not so optimistic. I mean, did we get a hammer on Friday? Yes, we did, and we did get the possibility of, we got some potential reversal candles on Friday for both of them, but just one possible reversal candle, especially if that doesn't end up being like something huge, like a big bullish engulfing or a bearish engulfing, if you're talking about an uptrend, or like some evening star formation or a morning star formation, especially with big volume or whatever, is not enough for me to get convinced that we're done pushing lower. So, I still haven't changed my thesis. It seems like the Euro USD has a very good potential of retesting at least the 113 area. The cable did hold the 128 at the first test, but I do still think that there is a decent possibility that we might see a push to new lows towards the 126 area of support. So personally, I would not be jumping the gun here. I would remain quite cautious. I think we need, especially in the cable, this looks very clearly like a corrective formation to me, and I want to keep respecting the potential for more downside. On the other hand, if we just have a look at the DXY, the DXY doesn't. The DXY actually had the best looking reversal candle on Friday, but if it invalidates that, it doesn't look all that bad. So it looks like, it doesn't have much of a momentum, and the RSI doesn't show, much of a promising potential. But that doesn't mean that it can't keep grinding a little bit higher. Perhaps we can make it towards, there is a nice confluence of resistances I like up there. Why? Because here at 97.85, we find the 61.8% fib of the whole move lower that we had from the beginning of 2017 until the low that we had this year at the beginning of this year. And we also have the 127% extension of this last corrective move lower. So perhaps we can keep grinding even, in this slow manner higher towards that confluence of resistances at 97.85, before we see something different. You know very well, those of you that have been listening to the webinar, that in the long term, I'm very bearish the dollar, but that doesn't mean that this will guide my decisions in the short to medium term. I have technical analysis for that. Now, my long-term thesis, whenever the technicals align with that, is just going to help me, push my short dollar positions even more, or use a little bit more leverage, or hold on to them, to looking to make like a bigger percentage of a profit or whatever. Other than that, I don't care about it in the short term, because in the short term, many different things can happen for various reasons. Now, something that we didn't mention on Friday, and I think it's quite important for us to revisit, is let's have again a look at the bonds. So we have seen, after breaking down, we have seen a rebound here in the treasuries. There is no question about it. But also, there is no question about it that a little rebound doesn't mean that the trend has changed. We actually, so far, we're getting rejected from the confluence of the 50% fib of the last move lower and the 50 daily moving average. But even if we rebound a little bit higher to retest these previous broken triangles support areas resistance, or this horizontal support resistance area, which is close to 120, a little bit lower than 120 actually, we might get rejected from there. So, we might see like a little bit of a big rebound from here, but I don't think that you have any reason to believe that we found a bottom in the treasuries. We need to see a lot more and a completely different upside momentum to even start you know, thinking about it. Now, having to do with the bunds, a decent rebound. We've pushed through the 38.2, this previous high, the 50 DMA, the 200 DMA. We're also getting rejected here from the 50% fib, but I need to stress out here, which is extremely important, that the bunds have been, you know, trapped within this descending formation, and we do see some whipsaw kind of moves. But as long as we hold in within this area, first of all, the chances remain very decent that this is going to end up getting resolved to the upside, simply because we entered this move that has very clear corrective characteristics from the downside, and, you know, having quite a nice momentum. So, you know, the best tactic here is to be buying when we're getting near the bottom of this. It's almost a channel. It's not exactly parallel, but let's call it, you know, somewhat of a channel. It's a triangle, but, you know, the lines are almost parallel. So the tactic here is to be buying the closer we get to support, and to be selling the closer we get to resistance, until we finally get a breakout. In which case, if we get a breakout, I think there is going to be very strong follow through, because the market, after such a long period of consolidation, in essence, what it does, it's coiling. A lot of stop losses are gathering in places that are going to actually help the bunds explode to whichever direction we finally break out. And as I said, I think there's a very good chance that that direction is going to be higher. Of course, until, you know, it gets confirmed, there's nothing more to say about that. Now, having to do with the metals, I also wrote it in the week, in the end of week analysis. Listen, the situation with the metals is quite simple. First of all, silver never made a new high here. It's actually chopping around and coiling within a symmetrical triangle. Usually that's not a good sign, because, you know, there is a high chance that, you know, the longer it takes for this to break higher, the higher the possibility that it's just gonna end up breaking lower in the direction of the trend and just push to a new low, which, you know, the next target is the 1362 low, and after that we have the 127% extension of that rebound, which comes at 1275. Now, if we
option traders love a setup like this, Steve. They just put on a volatility spread. You know, you buy calls, you buy puts. Exactly.
Exactly. It's called a collar, isn't it?
A collar. I think you're selling the options around.
Oh yeah, it's the opposite. You're right. Yeah.
You're long premium on this because
you're right. Sorry, I haven't traded options.
Compressed right now.
Yeah, I haven't traded options in 3 years or so. We were trading it in the fund, but, you know, with ForexAnalytix, I don't have any more time about that.
You know what I say about options? You know what I used to say? I don't say it anymore.
Yeah, it's like relationship. The vast majority of them end up expiring worthless, right?
Yeah, 90%. You remember all my lines.
Oh yeah, because they're good. To begin with, because they're good. Yeah, I remember them because they're good.
I also know that because I've had a few expire on me. All right, buddy.
So if we do end up breaking higher from this triangle, I still don't see the momentum that inspires me to be looking at this as a bullish move. So, you know, even if this ends up breaking higher, my initial thought is going to be, okay, let's draw a parallel. Now I'm doing it very, in a very choppy manner. Let's draw a parallel, which is going to be something like that. And let's look at it as a channel, because the momentum does not point to an impulsive move, right? So in that case as well, I would be like, okay, we have a nice confluence of resistances of this, let's call it a channel, because at that point it might end up being a channel, and this horizontal support area, which can act as resistance at 1520. So, you know, we might get an extension to 1520, in which case silver might completely fail and then see more downside. And an extra reason why I feel that might be the case is because what I'm now describing has already happened to gold. So there is still the potential that gold might rebound higher towards 1260. That's why I'm still holding to 1/3 of my position. But there is also a chance that it has already found a high in this channel, right? So I'm in the lookout because, you know, I see two technical possibilities. One of them calls for one more push higher for the two metals. The other one might point that we've already found a high and we are about to roll over and resume to the downside. I think that there is a very high possibility that this week we'll know which of the two is actually happening. Okay, so silver, since it's coiling in a triangle, I think it's going to be the first one doing the move. So if I see the silver breaking down from that triangle, I think there is a very good chance that gold is going to be failing at the same time. And if it does, I think it's going to push through 1200 and this ascending channel as well, and also head to new lows, right? And I remind you that, you know, my long-term thesis in gold is that it's going a lot higher, but as I said before, that doesn't mean that it will affect my short to medium-term view of the market, or deny me the ability to benefit even from shorting, although I'll probably not do it. Okay, I might do it as a hedge because I have a physical position at some point. We'll see. So this is the situation with the metals. Now, if I want to visit fast the other two, platinum, as you see, is rebounding from this ascending channel support. So it's still holding within this ascending channel. But as I was saying about gold, this price action doesn't look impulsive to me at all. So platinum is the most beaten down metal, and this looks to me just like a textbook correction. So I wouldn't be looking into it, making it very far. Now look how beautiful and how beautifully palladium has played out, because palladium came down, retested this horizontal support resistance area on Friday as support, rebounded from there, created a very nice hammer. We are moving higher today, and actually if we close somewhere here, we will be leaving behind us a morning star formation, which is a very bullish signal. So that might indicate that palladium is even more bullish than I thought, because we might just head higher from here. I believe that after this move, that we might see at least an ABC unfolding, and it might still be the case. But if we close, near the highs today, there is still the possibility that we might see another leg higher before we see a deeper correction. So keep that in mind. Palladium remains unbelievably strong, It really doesn't give you the ability to just, enter the market, because, after such a rally, you're expecting somewhat of a, deeper correction, but they never come. Now, having to do with copper. Copper once again at resistance. If you remember, I made it very clear that unless I see a daily close below 272, I still believe that there is a decent chance that we can see another leg higher towards 294. So, I'm still monitoring this channel. I'm still monitoring this horizontal support area 272. I'm still monitoring this 294 area as resistance. So I think that technically speaking, we're going to know what's happening here. Let me add a little detail to this. The RSI profile and the way it moved lower towards 50, 45 also points to a decent possibility of another rebound higher, right? The RSI yells more or less to me that so far this price action is in the short-term corrective. So I think that this correction, because I think this move higher has a decent chance of being a correction, is missing one more leg higher. Okay. So I think this covers all the metals, and we can go through some of the, let me see if we have any.
Nifty 50 in the reach once.
Yeah, let's have a look at it. There it is. Nifty, a nice rebound as well from here, but you know the technical damage has been done in the Nifty as well. So I would be quite careful here with, let's keep this. Let's assume that this is a short-term low that we had, and let's assume that we're going to get some rebounds, even if we fib this. Okay, we get the 23.6 at 10,400. This is also a previous low down there. But for me, important level is 10,600. As long as we remain below 10,600, I think you should be very careful. In the short term, this looks quite as a bullish candle. So, you know, yeah, we might get a rebound from there, but there's a good chance that we're going to fail from there, right? So perhaps a short-term rebound, but I would want to see definitely a move above the 38.2 to you know, to start looking higher. Another confirmation that we might be getting a rebound is this very clear RSI divergence that we're getting here, right? So in the short term, not a bad idea for a rebound rally to be looking higher. Okay, so let's have a look at a few of the yen pairs. We do have an interview today, right, Coach?
Yes, but unfortunately, I haven't been able to locate Mark Schaefer. I've done my bounty hunter routine. You know what bounty hunters do. You know, they hunt, and I sent emails and sent out a tweet, and he's not here. So possibility of a no-show today, buddy.
Okay, you let me know.
Okay.
So let's have a look at Euro Yen. Let's have a look at Pound Yen and the other pairs. First of all, Euro Yen, nice overthrow of this descending channel. So far today, a nice bullish engulfing. So a decent possibility of a rebound from here, but we need to confirm by seeing what kind of a daily close we're going to get, right? Keep in mind that 128.50 is strong resistance. So, you know, Euro Yen, more or less, this is like a choppy, expanding triangle. You can see it like that as well. I personally, I know that Amanda likes to trade it very much. Personally, I'd rather, I said it the other day as well, I think that the Pound Yen looks much cleaner. So, you know, if I had to choose one of the two of them, I would do so with the Pound Yen. And as you see, I've already drawn here. We've bridged through this support resistance area at 144.50. So far, we're getting rejected from there. As long as we stay below it, we might get an extension towards 139.90. But if we breach above it, we might rebound towards the 147.50 area. What, Coach?
Oh, Daniel's here.
Okay, Daniel is here.
My mistake. I had, yeah.
No problem. And let's have a look at the Kiwi Yen, which I wanted to point out again. And then you can start your interview. Kiwi Yen, beautiful channel. Fourth rejection from the support zone. Not something that you see every day. Triple bottoms, quadruple bottoms, not something that you see every day. Of course, for that to be confirmed as such, at the very least, we will need to breach through the channel. You know, if we actually end up rebounding quite higher from here, it's going to be quite impressive, to be honest, the fact that, you know, we will have actually formed some kind of a quadruple bottom. As I said, this is something that you see extremely rarely, but don't jump the gun. We're still in a downtrend. And, you know, one last thing, Aussie, USD, Kiwi. Kiwi is looking better again at the beginning of the week. As you see, a nice hammer on Friday, a nice rebound, but they still remain in the trend. Let me remind you that I'm still short the Aussie Kiwi, and I wrote on the weekend analysis that we are now retesting this broken triangle as resistance. And, you know, this is the last line in the sand for me. And so far, a nice rejection from there. So if we do get rejected from there, we keep alive the chances that this head and shoulders formation and this breakdown are going to end up playing out, and we're going to see a move towards the next objective at 1,063.50. So again, here tomorrow, I remind you, from those that are not in the US, that during this week, due to the lag that the US has to switch back to the winter time, let's call it, we're going to be starting 1 hour earlier until the US also aligns, because we're following the US time. We're a US based company. Okay. So thank you very much. We'll be back here tomorrow. Enjoy the interview, Coach.
All right. Thank you, Steve. Nice overview. Okay, Daniel. Thank you very much for showing up here on a Monday. I know you told me you're on Fox Business News last week. I made you the presenter. I don't know if you have a screen to share. If not, I can show your web page. And your microphone, I believe, is unmuted. Oh, there we go.
Can you see me? Can you hear me, Dale?
Yeah. You put together a nice PowerPoint for us. Nice
well,
meeting.
no, that's this is an old one, but I figured I'd put that screen up.
Okay. Well, great to meet you, Daniel.
Nice to meet you too. Your seminars are fantastic.
Oh yeah, you check them out every once in a while.
Yeah, I check in. I work out in the morning, so I listen to you guys, and I think you guys are such value to people out there who don't get it and don't understand it. So I give you a heads up for that. It's wonderful.
Appreciate that. So you were a floor trader on the knife.
Yeah,
right?
I started in 1983.
Okay.
Right out of college.
All right. So okay, it sounds like you had a similar path, only it took me 10 years to get my seat. So you went right to the exchange as a member. Why don't you tell us a little bit about your experience on the floor? Did you like being a floor trader? I learned to trade off the floor. So I really didn't really care for open outcry. They actually hand off my order so I wouldn't have an out trade the next day.
Right.
You know, people lost their seats on, you know, coming in the next day thinking they're flat and they're long a bunch or short a bunch.
Yeah.
So that was a great place to learn for a guy.
That was fantastic. It was fantastic experience. I mean, it was a different kind of crowd than I was used to. I was from Connecticut. So to go into lower Manhattan and deal with the floor traders, the street people, the guys that are smarter than I am, was interesting. But I did it. I did it for a short period of time. It wasn't long. But the experience was fabulous, because when I got on the floor, Dale, it was January 2nd, 1983. And I had just graduated college early after 3.5 years in December. I was 21 years old, and I was leasing my seat. I was a member of the exchange, but I leased my seat.
Right.
And I stood on the floor. I borrowed money because I came from no money. I borrowed from a friend.
Yeah.
And I just stood there in the middle of the pit, and the trading started, and I bought my first contract and sold it, made a little money. And
what was the active contract? The knife back then?
Yeah, the knife. Yeah, the knife was trying to emulate the S&P out of Chicago.
Okay.
So it was right next to the New York Stock Exchange. I used to walk around the New York Stock Exchange, but it was right next to it on Broad Street.
Right.
But one guy pulled me aside, and I said, "How you knew?" Blah blah blah. And he says, "Look, I want you to write these 5 numbers down on the back of your card, because remember back then we had cards every 15 minutes."
Right.
And I said, "What are these numbers?" He says, "These are the floor trader pivot points." I said, "What do they do?" He says, "Just follow it. When it gets up to this level, you sell it. When it gets down to this level, you buy it." And I was like amazed. And I studied that for years, tried to figure out why it works. And the reason it works is because it does. That's the only answer. There's no other rhyme or reason. Are you familiar with those?
No, but I know a lot of them. A lot of floor traders used to really like the X's and O's, point and figure charts.
Right. I never used those.
Yeah.
Right. So anyway, just let me give you a quick background, so your community knows who I am a little bit. So then Jimmy Kane heard about me because I did pretty good, and he hired me at Bear Stearns, and he gave me a desk with access to all the floors all around the world. So I started trading that, and then I decided that I didn't know enough. I was too young, so I went back to school. I got my master's in accounting, and I worked for Coopers & Lybrand. And I got my CPA, and I consulted Wall Street trading firms. And then I left that as soon as I qualified for the CPA, because I knew that wasn't my career. And I went on my own and started managing money for people. And over the years, I was with TradeStation. I started with TradeStation in 1990 with the Cruz brothers. And I was experimenting with their platform and designing my own trading programs. And by 1998, I came up with some really great concepts that were automated. And I started my own hedge fund. And then, well, I tried to do my own public hedge fund, and that didn't work because of September 11th. I was on the road trying to raise money. And I shut that down and moved it to a private hedge fund. And then Deutsche Bank heard about me, and they asked me to manage FX on their offshore platform. And then Societe Generale heard about me, and they opened up 4 hedge funds in Europe and the United States, 2 and 2, offshore, onshore, to manage commodities and currencies. And that's what my life was like before 2008, when I said to everybody that my systems are telling me to go to cash, and they don't like that. You know, they want to be in the market. And so I said, look, my systems are telling me what to do. I'm not going to override them. So I parted ways with everybody, and I predicted that the markets were going to collapse. I was on Fox Business. That's what my claim to fame was. And I just try to follow where the big money is going, and it takes time and you're patient, but usually it ends up there. So now I'm really basically a trader.
A proponent and follower of Commitment of Traders reports, to know that?
Yes, absolutely. Commitment of Traders report.
Part of your work.
Yes, and open interest is a key part of my work. Time and price is a part of my work. So I incorporate a lot of things together to get to where I'm going. I just want to see if there's anything else on this. So
what's your business model now besides trading for yourself?
Well, my business model is basically trading for myself. I manage a very small amount of money as an investment advisor. I cut that down, and I do a lot of speaking, public speaking, private speaking for traders and to organizations that want to hear about economics and cycles. I wrote a book called Profiting in Economic Storms, where I talk about all these different cycles.
I see. I could show it. Why don't you show that page? It sounds like you have every type of storm that could happen in the economy. One's deflation, one's hyperinflation. Right. You know, I'd be kind of interested, now that we know your background, to get a feel from you that, you know, some people think this might have been an inflection point in the market. I'm viewing it as a correction that's not complete, and maybe one more blow-off wave into next year. How are you positioning yourself in this market? You think it's over?
I think it's over. I think that, let me just switch out of here if I can. Let me see if I could do this, Dale.
Okay.
I'm usually computer literate, but not the best. Okay, let me go over here. This is Trade Navigator.
Okay, we see your chart.
Okay, great.
So we're looking at...
I'm looking at, first of all, I
natural gas.
But no, I key off of the bonds. I used to write a newsletter. I stopped it about 1.5 years ago. And it was ranked very highly in, I forgot the service that tracks them for a second. But I was ranked like...
Mark Holbert?
No, it's the, I'll think of it.
Timers Digest?
Yeah, Timers Digest, yeah. Okay. So I was ranked really high in the bond market movements. I was ranked #1 over the 3 to 5 year period and the 1 year. But what I did, this is my flavor, because to me, the bond market's the deepest market in the world. And you can't really fool around with the bond market. You know, the Treasuries, the Federal Reserve fools around on the short end, but they really can't.
I thought the currency market was the deepest.
I'm talking about, yes, currency market is the deepest.
Yes, anyway.
Yes, I'm sorry, in size. I'm talking about the commodity markets, you know, where you can see the commitment of traders.
Right.
So I've got, if you see on the screen there, you see how long the commercials are in the 10-year Treasury. And you see where that's the red line. The blue line is the large speculators, the hedge funds. And then the green line is the small speculator. That's a guy with less than 10,000 usually in his account. So I track this, and if I close it up a little bit, you'll see a little more of when those commercials get long, you're at bottoms, or if they get short, you're at tops. So this could go on for a period of time that's longer than sometimes I can bankroll.
Yeah, commercials have pretty deep pockets, and they're hedging.
Well, they're hedged. That's the thing. See, that's what people need to understand, is they're not losing or making. They're hedging against, they're net long, meaning that the endowment funds, the hedge fund, whoever it is actually long the treasuries and sitting on cash on anticipation that they're going to go up and they're going to buy them later. So it's a long hedge.
Right.
And the large speculators are basically speculating, putting liquidity in the market, which is great. I mean, I love speculation. So I look at that and it tells me, all right, we've got a situation here where I guess Stelios said that bonds could go lower before they go higher. I think he said earlier, was that Stelios?
Yeah.
One of your guys.
Okay.
I don't, and I saw some other people saying the same thing. I don't see that. I don't see that interest rates are going to go up. I don't think the economy can handle that on a GDP basis.
So you think the 320 print we had in 10-year yields was it? 325.
I think it was
lands
325,
flush, because there were a lot of people when we were recovering. What is this? A monthly chart, weekly? Before this last break, that were already pointing towards that, and then we had one more capitulation a few weeks ago, a month ago, in fact, right? So that was you're thinking, because technically there's pretty good non-confirmation on momentum indicators down there too. So they needed one more flush, and that was the Fed speak that took 10 years to 3.25.
That's what I see. And I also see, if you look down there, the bottom line, the open interest, tremendous amount of open interest. This is a very strong net long position, and they'll sit with that until it blows up. And it could blow up higher. I mean, I'm looking for maybe 122. If you're trading TLT can go to 140. I'm looking for interest rates to collapse below 2% on the 10-year.
So this will, based upon a big risk-off event in the stock market.
Yes. And
Most likely.
It won't be a crash, though. You see it when I go on TV. They try to get me to say, "Oh, there's a big crash." No, this could last 2 years, like 1973 and 1974. You could come in. Remember the days, Dale? We used to walk in and the market was like trickling down every day.
I was still in college. It's great to
know
that I didn't see some history in the market.
No, but even in the 80s,
Oh, okay. Yeah. All right. Thank you. It's okay. All right.
But if you look, I love your sense of humor.
I felt young for a minute. Thank you.
So now I go over to the 30-year.
Right.
And I'm looking at the 30-year popping up there, and I'm like, whoa, look at the commercials. So if you look where they did in 2017, if you can see
these are records.
Yeah, these are records. Look when they were net short, back here. Can you see my pointer? In 2016?
Yeah.
Look where they were, and look what the damage they did. So imagine where this is versus where this is now, where it was.
Right.
That the power, especially this open interest power, can take this up and just blow everybody away. And I don't want to disappoint your listeners, but my projection is a deflationary depression's coming. And that's what I see based on GDP, based on the amount of debt around the world that will not be able to be serviced, about the tax revenues being decreased, about the civil unrest. You've got all the ingredients. All we need is a bad weather pattern like the Dust Bowl to cause crop problems around the world, and you've got a serious issue going on. And that's what I'm kind of projecting.
So where do you live? I'm curious because, this is not, these aren't thoughts that, I haven't heard or thought about. Do you live here in the U.S.?
I live in Greenwich, Connecticut, yes.
Okay, so are you going to stay and be in the middle of it, or do you think about a haven so that you could watch it on TV instead of being in the middle of the social unrest? Huh?
Coach, can you hear me?
Yeah, I can.
Okay, I have a question for Daniel.
Okay.
Why would you rule out a dollar crisis once we go to the next recession and the Fed will have to monetize? I mean, we already had this year like a deficit of 1.2 trillion, not officially, but that's how much the US had to borrow because a lot of items are off budget. So why would you rule out a dollar crisis, which means that the next recession, instead of a deflationary, is going to be a stagflation? Why would you rule out that possibility, out of curiosity?
Maybe we have the deflationary part of it first so that people could buy assets cheap and then they reflate.
Right. We have the system, in my opinion, never rebooted. All the governments did was continue to put liquidity into the system, and it went to the wrong places. That's my opinion. If you look at the
I
stock
agree 100% with that.
Right. So therefore,
100%.
Okay. So therefore, when I go and look at some of the other indexes, I look at the shipping index, and I say to myself, goods, yeah, with the amount of money that was pumped into the system by the central banks globally,
there's no velocity.
Right. Well, there's no velocity there. There's no velocity in money. You know, the M3, the M2. There's the velocity of money's collapsed. People are not spending the way they claim they're spending. They're borrowing. They're borrowing, and this keeps getting worse and worse because the government keeps telling us that everything is great. They've changed the formulas for the unemployment. They've changed the formulas for a lot of things, and they're telling us that things are wonderful. Well, here in Greenwich or Fairfield County, there's a lot of people that can't eat at night. The food kitchens are bare because people are coming for food.
But that's a wealthy area, isn't it?
It used to be, absolutely. But Dale, these people are leaving. You got major hedge fund guys that left Greenwich and went to Florida.
Yeah.
The budget in Connecticut, New York, New Jersey, these states, it's awful. The taxes are awful. So, you know, to answer your question, am I looking to go somewhere else and watch it? I've got my toe in the water. I'm concerned. I don't know how deeply devastated it could get, but I just remember, I mean, I've studied the Great Depression, and one of your, you've had a speaker on, and somebody I follow puts charts together comparing 1934 to 1937, how we got a 95% correlation to that, and that the market.
That's where the Fed tightened. We were coming out of it, and the Fed tightened, and it was a mistake, and we double dipped. And
they're doing the exact same thing right now. There's no inflation. So why are they raising the short-term rate? Because does he not like President Trump? I don't know. You know, I'm a registered unaffiliated, so I'm not registered with any party. But there's just too much political storm out there, which is a problem for any country, and we all know that. Things are not smooth out there. So when I put that all together in historical, and I go back, you know, to the ancient Greeks, the ancient Egyptians, the ancient Romans. If you look at what we got, the ancient Greeks were competitive at the political level. They started fighting at the running of the government, and that destroyed their society. That's where the Olympics come from. They're very competitive. Then you got the ancient Romans. The Romans went broke, and they also had people infiltrating their army. That was a problem. Then what happened in Egypt? Well, they grew the wheat and the crops based on the soot that came in from the Nile, the river, and all of a sudden it stopped, and they couldn't grow those crops anymore. So I look at what happened in history, and I look where we are today. You know, United States is a young country. It's not as old as the European countries, and so we're still in the learning phases. And unfortunately, we now are a divided country, and the markets are going to basically. People are basically going to stop spending, they're going to stop investing, and this whole cycle could reverse. And that's the scary part that I see. And I see that like in the indicator that I'm showing you. I see that in the spreads. If you look at the 10-2 spread, look at this.
So you're looking for the inversion. And so the only place to hide is cash and treasuries. And do you, so let me ask you, is that bullish for the dollar? In that scenario, that could take the dollar sharply higher, right?
It will, but not
initially.
Yet. In my opinion, not yet. The dollar's not ready to go yet. It will be ready to go. Let me just pull that up, the dollar index. I trade the individual currencies myself. I don't trade the index. But I see a wave here that if you look where the commitment of traders are, they're not neutral here.
Oh,
they're short. They're short. So I'm waiting for this to build up a little bit more. I think there's trouble, like you had been talking about, at the 95.50 area. We're a little bit above it. This could be what they call it, like you guys know, the ABC. You got a double top, something here. Something needs to pull back. Get these guys back.
Yeah, that's what I'm looking for. 93 would shake them out.
Yeah, absolutely. Or even a little lower, right there. And bring these guys back up here, which I think is just going to be maybe a month or two. And then we're going to see this. So I'm shooting for 112 eventually, which would put the euro below par,
parity.
And that would put gold about 800. That's what I'm kind of looking at.
Okay.
That's my scenario. I do believe we're going to get. I'm long gold. right now. So I think there's a chance we'll get a nice pop in gold just based on the trading cycle that's coming in here for the end of the year. And you see the commercials are not that short here yet. In fact, they're kind of at levels where we saw back in 2016, where they were neutral, and then it kind of popped as they got short, you see. So I need them, I would like to see it test this 1265, 1260 level. Then I think we'll get that drop, and we'll see that in the commitment of traders.
And what's your downside target? 850, you said?
800 on gold. Yeah.
Okay. Well,
below...
you know what? You brought up age and history. How about back to the last bull market high of 1979, 1980 of 880 when Russia invaded Afghanistan and the Hunts brothers had the silver squeeze at $50? That would be kind of a natural, because from there we went down for 20 years until 2000.
That's true.
Write that number down, 880. That was a high in 79.
For gold, you mean?
Yeah.
Yeah, 880 to test that 880. Yeah, I don't disagree with that at all.
High before, the last bull market when guys like Maury Kravitz were like the king of the pit at the IMM.
Right, I agree with that.
Yeah. Okay. So wow,
I mean, just look at lumber.
Interesting analysis.
Dale, look at lumber.
Yeah.
Where's the great housing they were telling us about?
Well, 6 months ago, it was 650. So we've had a lot of real sudden, dramatic, impulsive waterfall declines in a lot of different asset classes. Yeah, the housing market index looks the same.
Yeah.
Yeah, S&Ps.
S&P, look at that. I mean, that to me is a very dangerous top.
Yeah.
And it's due. 2018 is a good due date for this, and a lot of cycles come to fruition where, in my opinion, again, I'm not giving your audience advice, but my opinion is I'm going to be selling rallies all the way down to 2100 on the S&P. That's what I think is coming.
Daniel, if I may interrupt again, I agree in like 99% of what you say. I honestly do, in everything. That the system has been completely mismanaged, that they tried to mount a recovery based on the wrong tools, which is simply trickle down, theoretically speaking, economics just by using monetary policy. I agree with everything with you. But I'm asking again, what makes you think that the third time will be the charm? Meaning that the US dollar is going to actually sustain its buying power after the US starts running, because I guess we agree on the fact that if now, theoretically speaking, during a period that the US is not in war, it's in an expansionary phase, it's actually spending more than 1.2 trillion that it doesn't have every year and it has to borrow, the moment tax collections go down after the next recession begins and all the entitlements of unemployment, etc., start kicking in, and if they try to do some Keynesian economics as well, they're going to be running a $2 to $3 trillion deficit. So what makes you think that during the next crisis, the faith to the US dollar is not going to be destroyed? So in essence, added to the fact that we're going to have a depressed economy, we're also going to have appreciating prices in the US due to a dollar that's going to be depreciating very fast in price. So in essence, stagflation. That's my only question, because I agree in anything else with you. I'm a little bit skeptical about the possibility.
Steve can't see how you could have a bull market in the dollar with the U.S. economy and deficits going to be. Could it be, Daniel, that it's all the dollar-denominated debt around the world that during this deleveraging, it's just such a great demand for dollars that the economic condition of the U.S. isn't as important as rolling debt?
You just hit it right on the head. The fact that debt around the globe is denominated in U.S. dollars, as this debt defaults, there's less dollars in the system. So therefore, the dollar would become more valuable. The student loans, the auto loans, absolutely. So that's the area. You just got it. That's exactly what I see, is that there's going to be a repatriation of a lot of money coming back to the United States. They're going to put it into the treasuries, which will also help the treasuries rally. And therefore, where else could you go? What if you're not in the U.S. dollar? Where else would you go? You're going to go to the bitcoins of the world? That's not going to help. Can you go into gold?
That's not my point for sure. I believe Bitcoin and all the cryptocurrencies are going to, I think the risky assets, and I believe in the next crisis, the vast majority of them are going to evaporate, literally.
Oh, absolutely. Absolutely. There's no question about it. In fact, that's an experiment that all the central banks are watching, and they're going to learn from all the mistakes because they'll eventually do the crypto. But the bottom line is, where can you go? If everything points to what I see, where would you put your money? The U.S. dollar, the United States, is probably, in my opinion, at this moment, the safest country in the world to hold assets. But if you put your money in gold, how can you go down to the local supermarket and buy things with gold? They're not going to take your gold. So you need some kind of a liquidity, and that's going to be the U.S. dollar. When I travel around the world and I go to different places, they take the U.S. dollar. They take cash. These foreigners, they love it. This is a demanded currency. It's not going to go away. I've heard about these petrodollars and all this other stuff. That's not going to happen. You know, the oil crisis is just around the corner, where I think oil, part of this, I just have it on the chart there, I think oil is going to collapse and test the low of 25. The demand for oil is going to drop dramatically. So with all this happening, where would you go? And now I've heard the other story, that the dollar is going to collapse because of all the U.S. debt, and gold's going to go to 5,000. That may happen, but not. I don't see it in this
later.
Yeah.
Out of desperation, when the Fed is QE infinity in helicopter money.
Right.
After the deflation.
After it goes to 112, yeah, it could drop back to 50.
Yeah.
But during this cycle that I see materializing over the next 2 to 3 years, or I don't know how long it could last, this could be very serious. And I've studied the depression, and I've studied what happened in the 1890s. We had a depression in the 1890s. I studied 1907 with the banking problem.
The longest depression was after the Civil War. It was 25 years.
Right. I mean, and speaking of Civil War, look what we got going on here, Dale.
Yeah, I know.
I mean, we're on the edge of a civil war with the words that are being spoken.
I know. Yeah.
So I look at all that, and and everybody says, "Oh, everything's great because the stock market's up." That's not the answer. That's not the answer. And
thanks for cheering us up today, Daniel. And
oh, it's a pleasure.
I'd rather, sometimes I wish I didn't know, and I could have been an ostrich and just had my head in the sand and tra-la-la-la-la, row your boat gently down the stream. But it's becoming harder and harder to ignore that there's something wrong. And,
exactly.
The timing of this, maybe you're such a big bear and we're heading into November when you should be thinking about hibernating. Are you going to take the season off and stay awake instead of hibernating this winter?
No, I mostly day trade. I love it. In fact, it's too bad we ran out of time because there's so much that I wanted to show in that reference to day trading. It's just, phenomenal what goes on with those.
We'll do it again.
Absolutely.
I appreciate the macro and appreciate you bringing your charts and presenting.
We don't have anybody really pressuring us. I mean.
Oh, okay.
Yeah.
Go ahead then, Daniel.
Daniel, go ahead. I mean,
Steve is like my producer.
15 more minutes. I mean, it's going to be.
If you guys broke
a pleasure.
I got 15 more minutes because I'm not.
Oh, absolutely. It's our pleasure.
Sitting in one of those chairs like you see in Hollywood with one of those megaphone horns. Action. All right.
All right. So the floor trader pivot points, if you're looking for entries during the day, these are really great. Now, this is the charts. This is the current euro. I follow the commodities to trade the spot because it tells me what the guys are moving in. So if you see those lines going across, the middle line is the pivot, and the upper two lines are the resistance areas, and the bottom lines are the support areas. And this is a formula based on, let's see if I can get there. Here, the expected highest high, expected high, the pivot point, the expected low, and expected lowest low. And guys, you can Google this formula. It's simple. This is it. There's nothing complicated to this. And there's no mathematical reason for this because I'm a CPA. I count cards at blackjack. I understand numbers. This just works because people follow it. So I go back to my screen.
You just proved my theory. You know, people always say, Daniel, I know the secret to trading. And they'll sell you the secret for, I don't know, about $1,000 or so. But really the secret is if you could add and subtract, multiply and divide, you could trade.
That's it. That's really it. You got now. Just Dale, look at the right-hand screen. I got a tick bar. Now TradeStation gives me. I could do tick bars. So this is 1,500 ticks per bar. So if you look, you can even see it on the left-hand screen on the 1 minute. That pivot point has some validity to it. It came up to it. It pulled back from it. It broke through it. It came back and tested it. And then it touched it right at the top about what, a minute, 2 minutes ago, or three. I don't know, 1,500 ticks. So I look at this and I say, okay, I'm going to trade off of this. And I look at certain times of the day. I also have this thing I built which shows me the number of contracts or the size contracts per trade. So when the contracts get really big on the upside on the offer price, I get a thing that says on the bid, as if I see a large quantity of bids being hit by size of 10 or 15 contracts lots at a time, that tells me the pros are selling it. And then I get buys down at the bottom that the pros are buying the offers. And that kind of gives me an inter movement during the day that I kind of follow.
So the pros sell on a full moon and they buy on a blue moon.
Well, listen, absolutely. I'm a big believer in the moon cycles too.
Yeah, me too. I'm a lunar tick.
We came down from October 4th on a new moon into the full moon, October 24th. I was on Fox. I said that 3 weeks ago. There'll be a strong bottom, and something's going to happen on October 24th. Look what happened. You had the bombing guy. You had Megyn Kelly losing her show. You had a lot of, and the market was down 600. Things happen.
I think I had hemorrhoids that day, Danny.
Well, listen, I hope you feel better, by the way. I've had pneumonia before, and it's not fun.
Yeah.
So, just take care of yourself with that.
I rushed it a little bit. But, what a great guest you turned out to be. And I just took a shot. I saw your, a tweet by you. And that's what I do. I reach out and, want to help edify our community. And you did a great job today, buddy. You have a lot of knowledge to share. And you got a lot in a half an hour. You're now my trading warrior brother, like it or not.
Thank you. Oh, I appreciate that. Listen, I got a lot of wounds too, so I learned from a lot of wounds.
We all do.
Yeah. All right. Well, thank you very much. If you ever want me to come on again and update, I'm here. I kind of cut down my business. This is just what I do.
Okay, buddy. It was great meeting you. Everyone, thank Daniel Schaefer. You could follow him at Daniel S. Schaefer. And what's that page? Let me show people. You know what? I think that people should take a look at maybe getting your books. Let's see. I'm going to show it. So Daniel wrote Profiting in Economic Storms. If you want to, be prepared for the bear case, these are probably some other interviews he's done, but this is his website. This is your web page here.
And those clips are from me on Wall Street Week with Anthony Scaramucci.
Oh, okay. Yeah, I was on with Louis Brookhiser.
Oh, he was great.
Didn't he look like George Washington?
He sure did. In fact, when I just got remarried a year ago, and I was on my honeymoon down in the Grenada, and his daughter was at the place that I was getting married.
Huh.
And we had a nice conversation. He was here in Rye, right next to Greenwich in New York.
Huh.
So interesting fellow.
Thank you so much, Daniel. Good hunting. I hope pips rain down on you.
Thank you. You too, and everybody in your community. And thanks for what you do. I think it's wonderful.
Thank you, Daniel. Okay. Daniel Schaefer, everybody. Forex Gal says thank you. Bob wants to know if you have a newsletter. Daniel does have the secret. Great interview. So thanks again, Daniel, and I'll see everyone for Turnaround Tuesday tomorrow. And remember, don't just count your pips, count your blessings. Adios, everyone. Thank you again, Daniel.
You're welcome.